Former President Donald Trump's campaign to push the Federal Reserve's benchmark rate down to 1% has gained renewed attention. On the surface, such a move promises cheaper borrowing, from mortgages to corporate debt. But ultra-low rates are historically a tool of last resort during severe crises, not periods of stable growth. This article examines the rationale behind Trump's proposal, its potential effects on inflation, government borrowing, markets, and everyday Americans, and why many economists warn that a 1% rate without a genuine emergency could do more harm than good. Current Federal Reserve policy. As of mid-July 2025, the Federal Reserve's target federal funds rate stands at 4.25% to 4.50%, a level policymakers view as moderately restrictive to balance cooling inflation with supporting growth. Inflation has eased toward the Fed's 2% goal, unemployment hovers around 4%, and GDP growth remains modest but positive. While markets anticipate a modest quarter-point cut later in 2025, the Fed has ruled out drastic moves absent a clear downturn. Trump's 1% proposal. On multiple occasions this summer, President Trump publicly urged the Fed to slash rates to below 1%, calling Chair Jerome Powell a knucklehead for resisting deeper cuts. Trump argues that each percentage point reduction would save trillions in interest on the $36 trillion national debt and spur economic growth. He has even suggested he might dismiss Chair Powell to force the Fed's hand, though he later backtracked, acknowledging such a firing would be highly unlikely. Why push rates so low? 1. Government borrowing costs. With massive spending on infrastructure, defense, and social programs, lowering rates slashes debt service expenses. At 4.5%, the annual interest on $36 trillion exceeds $1.6 trillion. A cut to 1% could reduce that by more than $1 trillion. Second, short-term growth. Cheap credit can boost consumption and investment, potentially lifting economic activity in the months immediately following a cut. Third, political appeal. Low rates tend to correlate with booming markets and easier personal borrowing, politically popular outcomes for any incumbent or candidate. Historical precedents for 1% rates. All previous instances of Fed funds near 1% coincided with acute crises. Post 9/11, 2001. Rates cut to support an economy reeling from terrorist attacks. Global financial crisis, 2008-9. Drastic cuts prevented credit markets from seizing up amid collapsing financial institutions. COVID-19 pandemic, 2020. Emergency action to avert a depression as lockdowns halted economic activity. In each case, the low-rate policy was temporary and tied to an identifiable emergency. Presently, by contrast, key indicators show neither deflationary pressures nor credit market dysfunction. Implications for government debt. Lower rates would immediately reduce the federal government's interest burden, but they also risk moral hazard. Cheap borrowing may encourage further fiscal expansion, compounding long-term debt sustainability challenges. Refinancing surge. Plunging rates could trigger a wave of bond refinancing, boosting demand for treasuries but potentially crowding out private borrowing. Moreover, if global investors fear the Fed is politicized, pushing rates below levels justified by economic fundamentals, they may demand higher yields on long-term debt, erasing any short-term budgetary gains. Effects on markets and investor confidence. While a 1% federal funds rate would instantly lower short-term borrowing costs, its impact on long-term yields, such as those on 30-year mortgages and corporate bonds, hinges on investor expectations about inflation, policy risk, and the Fed's independence. Risk premiums rise. Uncertainty. Premium. When investors perceive that monetary policy is being influenced by political considerations rather than economic fundamentals, they demand higher yields to compensate for added uncertainty. Flattened yield curve. In theory, forcing down short rates should steepen the yield curve, long rates minus short rates. However, if investors fear future inflation or policy reversal, long-term yields may actually rise, flattening or inverting the curve and signaling recession risks. Dollar weakness. Global reserve currency. The U.S. dollar's status as the world's primary reserve currency rests on confidence in America's economic management and institutions. Aggressive cuts to 1%, unmoored from macroeconomic conditions, could erode that confidence. Imported inflation. A weaker dollar makes imports more expensive, feeding into consumer price inflation at home. Countries exporting to the U.S. may see higher relative prices, prompting second-round inflationary effects. Potential for policy backfire. Credit conditions. Rather than easing credit, an erosion in market confidence can tighten financial conditions. Banks and non-bank lenders may raise lending standards or widen spreads, offsetting the Fed's intended stimulus. Volatility spikes. Each public comment by political figures on Fed decisions could trigger outsized market reactions, amplifying swings in stocks, bonds, and foreign exchange markets. Impact on consumers and businesses. Homebuyers, mortgage rates versus Fed funds. Most consumer mortgages, particularly 30-year fixed rates, track the yield on long-term Treasury bonds, not the overnight rate. If long yields remain elevated due to risk premiums, mortgage rates may stay unchanged or even climb, despite Fed cuts. Refinancing window. Should long-term rates fall modestly, homeowners have a narrow opportunity to refinance. However, closing costs and reset risks, e.g. variable rate ARMs, require careful cost-benefit analysis. Savers and retirees. Shrinking income. Individuals relying on interest from savings accounts, certificates of deposit, CDs, money market funds, or fixed income annuities would see yields plunging. A 1% Fed funds target often translates to sub-1% returns on bank products. Eroding principal. If retirees maintain spending levels while interest income falls, they may be forced to draw down principal, risking depletion of retirement nest eggs. Risk-seeking behavior. Some retirees might chase yield by moving into higher-risk assets, such as high-yield bonds or dividend-paying equities, exposing themselves to market downturns. Borrowers, credit card and auto loans. Lenders of unsecured debt often price loans based on benchmark rates plus risk-based spreads. While the Fed's cuts reduce base funding costs, spreads may stay wide if lenders perceive elevated credit or policy risk. Student loans and corporate debt. Federal student loan rates are pegged to Treasury yields. Aggressive cuts could lower monthly payments. Corporations could refinance existing debt at lower coupons, but only if bond market conditions permit. Businesses and investment. Capital expenditure. Cheaper borrowing costs can incentivize capital projects, factory upgrades, research and development, and M&A activity. But elevated long-term yields or policy uncertainty could dampen these incentives. Bank profitability. Banks earn income from the spread between deposits and loans. A prolonged ultra-low-rate environment squeezes that margin, potentially leading banks to tighten credit standards or raise fees. Risks to Fed independence and credibility. The Federal Reserve's operational independence is a cornerstone of effective U.S. monetary policy. If political pressure appears to dictate rate decisions, the Fed's credibility, and by extension, the entire economy's stability can suffer. Credibility erodes. Dual mandate jeopardized. The Fed's mandated goals of price stability and maximum employment risk being overshadowed by political priorities, prompting market doubts about the Fed's commitment to controlling inflation. Long-term expectations. Inflation expectations are partly shaped by confidence in central bank resolve. If markets believe emergency tools are used irresponsibly, inflation expectations can drift upward, leading to real price increases. Volatility increases. Market sensitivity. Politicization invites overreaction to every presidential tweet or public statement. Traders may amplify moves in derivatives and currency markets, increasing financial market volatility. Policy predictability. Lost. Without clear, data-driven guidance, businesses and individuals struggle to plan investments, hiring, or major purchases, undermining economic growth. International implications. Global coordination. Emerging market economies often align their policies to U.S. signals. A perceived breakdown in Fed independence could spill over, causing capital flight, currency crises, or synchronized financial disruptions abroad. Broader economic and fiscal implications, deficit and debt sustainability, short-term relief versus long-term risk. Lower rates reduce annual interest outlays on the $36 trillion national debt. But they also may incentivize further fiscal expansion, aggravating debt burdens down the road. Refinancing surge. If the government rushes to refinance at rock-bottom rates, Treasury auctions might temporarily soak up global capital, leaving less available for private sector borrowing. Fiscal monetary coordination. Boundary erosion. Healthy economies maintain a clear boundary between fiscal, congressional spending and taxation, and monetary, Fed rate-setting policy. Blurring these lines can undermine future policy tools and accountability. Inflation risks. If fiscal deficits balloon under a low-rate regime, unchecked money supply growth or persistent budget gaps could reignite inflation, forcing the Fed into abrupt and painful policy reversals. Strategies for individuals and firms. Given the potential for market distortions and policy volatility, individuals and businesses should adopt proactive measures. 1. Review your portfolio or diversify across asset classes, equities, real assets, international exposures that are less sensitive to U.S. interest rate moves. Stress test retirement plans under scenarios of ultra-low rates followed by sudden tightening. 2. Refinance. Cautiously calculate break. Even. Determine how long it takes for lower monthly payments to offset refinancing costs. Lock wisely. Consider rate locks or float-down options to protect against rising long-term yields. Maintain a cash buffer emergency fund. Keep 3 to 6 months of living expenses in liquid, low-risk accounts, recognizing that returns may be minimal, but accessibility remains paramount. Ladder deposits. Use CD ladders to capture slightly higher yields without locking in the entire portfolio. Stay informed monitor Fed communications. Read FOMC minutes, press conferences, and official speeches to gauge the institution's stance. Follow market indicators. Watch yield curves, credit spreads, and the dollar index for early signs of shifting investor sentiment. 5. Diversify income sources side income. Develop non-interest income streams, consulting, gig economy work, or royalties that are less vulnerable to rate moves. Dividend strategies. Focus on high-quality dividend-paying equities with stable payout histories rather than chasing yield alone. Conclusion. A 1% federal funds rate without a genuine economic crisis would break historical precedent and carry significant risks. Inflating long-term borrowing costs via higher risk premiums, weakening the dollar and importing inflation, squeezing savers and retirees, and eroding the Fed's hard-won credibility. While short-term headline benefits, cheaper loans and reduced debt servicing, are tempting, the unintended consequences for markets, fiscal sustainability, and global confidence could far outweigh those gains. As debates continue over the appropriate policy path, individuals and businesses must prepare for a range of possible outcomes. By diversifying portfolios, refinancing prudently, and maintaining liquidity, you can weather policy shifts and market volatility. Above all, safeguarding trust in the Fed's independence, in the stability of the dollar, and in the robustness of the U.S. economy remains paramount. Because in finance, as in life, the quietest shifts often have the most profound impact.